welcome to Talk Tickers. So Nebius Group just reported earnings, and boy, was it a wild ride. The stock absolutely cratered, but if you listen to the CEO, they are drowning in what they call unprecedented demand. So what gives? Let's get into it. Let's break down their Q3 2025 earnings call from November 11th and figure out what is really going on here.
All right, so here's how we're going to tackle this. First up, the numbers themselves and how the market reacted, or maybe overreacted. Then we'll get into the bull case, which is all about that crazy demand. After that, the bear case, and well, it's all about the cost. And finally, we'll wrap up with our take on it, our view for the next call, and even a trade idea.
All right, first up, the numbers and the reaction. And really, this whole quarter is a tale of two very, very different stories.
Okay, so let's look at the actual numbers. It was, kind of a mixed bag. On the one hand, they actually beat on earnings per share, reported a loss of 40 cents versus an expected loss of 52 cents. So that's a pretty decent beat, right? But, and this is the big but, they missed on revenue. Came in at about 146 million when the street was looking for something closer to 155 million. And you can probably guess which one of those numbers the market decided to focus on.
Yep, the stock got hammered, down 7%. The market saw that revenue miss and just sold off, pretty much ignoring everything else, including some really strong year-over-year growth numbers.
Okay, so that's the market's reaction. Now let's talk about the bull case. Let's hear management's side of things, because their story is all about one thing: insane, off-the-charts demand.
The CEO, Arati Village, basically said it point blank on the call. Every time we bring capacity online, we sold it all. If we had more, we could have sold more. I mean, you can't get much clearer than that. This is not a people don't want our stuff problem. This is a we literally cannot build it fast enough problem.
And look, this isn't just talk. The proof is in the pudding, right? They're landing huge contracts. We're talking a Microsoft contract worth somewhere between $17 and $19 billion. A new deal with Meta for around $3 billion, plus a whole bunch of up-and-coming AI startups. These aren't speculative deals. This is real, validated demand from the biggest players in the game.
So how are they planning to meet all this demand? Well, they're building. A lot. Here's the roadmap they laid out. By the end of this year, 220 megawatts of power. By the end of next year, they're aiming for up to a full gigawatt online, with more than 2.5 gigawatts already contracted. That is just a massive, massive scaling of their footprint in a very short amount of time.
And what does all that capacity translate to in terms of dollars? Well, here's the number that really gets the bulls excited. $7 to $9 billion. That's the annualized revenue run rate management thinks they can hit by the end of 2026. I mean, that's a staggering number. It's a huge leap from where they are today. If they even get close to that, wow.
Okay, so amazing growth story, huge contracts, a clear path to billions in revenue. So why did the stock get crushed? This brings us to the bear case. And it all comes down to one simple, very expensive word: cost.
I mean, just look at these cash flow numbers for Q3. They burned through nearly $1 billion in CapEx in one quarter. And that's not even the whole story. They raised their CapEx guidance for the full year to around $5 billion. That is an eye-watering amount of money to be spending.
So where's all that money coming from? Well, this is the other thing that spooked investors. They announced a new at-the-market program, or an ATM. Basically, this lets them sell up to 25 million new shares, pretty much whenever they want, directly into the market to raise cash. And if you're an existing shareholder, you know what that means: dilution. Your slice of the pie gets smaller. So, let's put it all together. This is what's worrying the bears, right? You've got the revenue miss, which makes you wonder about execution. You've got this insane cash burn. You've got the risk of dilution from the ATM program. It all comes down to this: they have to execute flawlessly to hit those 2026 goals. There is just no room for error.
So that's the dilemma, isn't it? You've got this incredible story on one side and this terrifying balance sheet on the other. So how do we think about this going forward? What should we be looking for in the next earnings call?
For us, it really boils down to three key things to watch next quarter. First, capacity. Are they actually making progress on that 2.5 gigawatt goal? We need to see concrete updates. Second, capital. How are they using that ATM program? Are they burning through cash faster than expected? And third, contracts. Are they getting those Microsoft and Meta deployments up and running and actually starting to recognize that revenue?
Okay, so where does that leave us? For now, we're slapping a market perform rating on this. Look, the demand story is incredible and it's real. But the execution and financing risks are just too big to ignore right now. The potential reward is massive, for sure, but so is the risk.
All right, that brings us to the last piece of the puzzle, the trade. And of course, the big flashing disclaimer here, this is not financial advice. It's just an idea, a way to think about the setup.
So the question is, how do you play a stock like Nebius right now? It's super volatile. You've got this huge tug of war between the bulls and the bears. Is there a smarter way to approach this than just buying shares and crossing your fingers?
Well, one idea to think about is selling cash-secured puts. The logic is pretty simple. After that big drop, fear is high, which means implied volatility is high. And high volatility means option premiums are juicy. So the strategy is this. You sell an out-of-the-money put. If the stock hangs out or goes up, the option expires worthless, and you just keep the premium you collected. If the stock keeps falling and you get assigned, well, you end up buying the stock, but at a lower price than it is today, a cost basis you are already comfortable with. It's basically a way to get paid to wait or to buy the dip at a discount.
But again, and I have to say this one more time, this is not financial advice. Definitely do your own research here. This is a tricky one. We'll be keeping a close eye on Nebius. Until next time, trade smart.